You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome back to the show, everyone. It's Wednesday, so it is our day with Zulfi Ali from Valerity Group. Welcome back, Zulfi. How are you?
Great to be back again. Thanks for having me, Buck.
Yeah, so these shows have gotten interesting, and I'm learning a lot. You know, like last week we started, you mentioned the yen carry trade, or was that 2 weeks ago? But
no, that was just last week. Yeah. A lot has happened.
A lot has happened. And then I started hearing about it everywhere, and I actually knew what they were talking about. So that was a very helpful. I mean, for me, it was very helpful because it seems strange that, I mean, I get the sense that that's such a nuanced thing that it's not like, you know, most people would know that was something, right? That was something, or is that really common on knowledge on Wall Street and in the financial space?
I think even on Wall Street, I think it was a bit of, something out in left field where I think everybody assumed initially that the big reaction, the sell-off that we saw early last week was pretty much on the heels of that higher unemployment report. And so I think the initial reaction that I saw was everybody thought, okay, this is all related to this unemployment figure going up. The hard landing scenario is coming. But I think there was, some folks that said, hey, you got to take a step back. There's some crazy stuff happening that impacts our markets here and causes a bunch of sellers and that sort of thing.
Yeah, so, just as a review, basically the idea was that because, Japan has been in this I guess recession or depression for now probably about 30 years, that they have been at like 0% interest for I don't know how long. And so what people were doing was like, institutions or super ultra wealthy people were borrowing money from the Bank of Japan, basically at almost, zero interest, and then, investing in equities in the US and stuff. And the next thing you know, you've got they, for the first time in decades, actually slightly increased their interest rate. I think was it even like 25 basis points?
Yeah,
25 basis
actually
points.
At 0.25.
Yeah.
So it was pretty much zero before.
But that alone created this huge panic, and I guess, people getting worried about covering their leveraged positions. And so you can imagine typically in that situation, what you're going to see is a sell-off on higher, perceived risk type positions. So that's what we saw, right? Lots of sell-off in tech. We saw Bitcoin get absolutely pummeled. Now, the other thing I heard about that, and we'll get to the current situation in a second, but just to follow up on this, was that about 75% of that, apparently those trades have unwound. Yeah. So the other way to look at that is there's still 25% left. And then you wonder what else is out there. This is just the kind of stuff. It reminds me of long-term capital management, in the 90s that, basically took down a good chunk of the economy. Nobody had any idea what they were doing, right? This is exactly what happens in these situations, right? It doesn't take much. So.
Yeah, that's in fact one of the first times I remember the Fed stepping in was on the back of long-term capital management's downfall.
Right.
So that began the process of the Fed bailout after bailout after bailout, which is continued.
Yeah. All right. Well, let's talk about most recent podcast that we did released on Sunday. What's your feedback on that?
Well, I think there was two parts to your podcast, Buck. One was, I think there was the section where you are referring to Campbell Harvey and all the, components of CPI that are, focused on shelter and how that's such a lagging and really kind of a propping up the current CPI levels and insurance assumptions, that sort of thing. So I thought that was interesting. And, I myself am keeping a very close eye on that. I think, it'll be great to see what happens, with the CPI numbers coming out over the next, next few months and quarters. In fact, there's a CPI print that is expected to come out tomorrow, Wednesday. I guess by the time this podcast comes out, it may be out at that point. But, that is expected to remain flat, which is a 3%, 3% year over year growth. in CPI. So 3% is still higher than what the Fed wants, obviously. But to your point, I think Campbell Harvey's got a really interesting point there, that you should see that coming down dramatically as the shelter cost component catches up to reality and isn't reflecting something that was happening a year ago.
So just to review kind of what we're talking about. So the CPI was 3%, and Campbell Harvey, who's been on the show, this is the guy who was the one to describe sort of the inverse yield curve correlation to recessions. That was his PhD thesis. He's a very smart guy. But what he's been talking about for a while is this idea that 70% of CPI is made up of shelter, essentially rents. I mean, that's what it comes down to. And that it's a lagging indicator, and that the current one, even at 3% CPI, assumed shelter running at 5.2% year over year. And we know no one thinks that year over year right now, like that we're running at a 5.2% increase in rate rents. We're actually flat. And his point was that even if you were generous and gave it 2%, CPI would be below 2. If you follow this out, the idea is that, you could be very quickly running into sub 2, close to 1 CPIs if that 70% starts to catch up in a hurry. And yeah. So he's beating the drum on that, and the Fed stepping in and going not to 25 basis point reductions in September, but 50, and trying to get ahead of this.
Yeah. So that's obviously, on the inflation side, which is half of the Fed's mandate, to make sure that, inflation stays contained. So again, Campbell Harvey says, guys, it's contained and it's heading further south. The other piece that the Fed has to focus on is the labor market. They need to keep a healthy labor market as part of their mandate as well. And I think the other kind of indicator that you referenced on the podcast was the SOM rule, and I'm not sure if you're familiar with what that is. It's an indicator that was created by an economist, Claudia Somm. Not too long ago, like about 2019, she came up with this, but it's based on historical data. And so if you look at the SOM rule, it has predicted, whenever it's been triggered, it's been predicted every recession since 1970 as well. And what the SOM rule is that it's a measure of labor, basically the labor market loosening up. So when the 3-month average unemployment rate rises by more than 0.5% from its 12-month low, that means a recession is kind of in the works. And that's, again, it's a measurement that historically has played out. And, it could be a signal here again today, is that, okay, well, you don't have inflation. You've got unemployment, which has been consistently increasing. What the SOM rule really says is that when you get to a certain point, it actually starts to accelerate. And that's the trigger. When the SOM rule is effectively triggered, and that's where we're apparently at now. All that being said, Claudia Somm herself has come out in an op-ed not more than a few days ago saying, "Hey, this the SOM rule may not be as relevant in today's post-COVID economy, just because we've had so many distortions in the labor market and inflation and all that sort of stuff." So she's kind of putting a little caveat on there, but it just sends another message that there is a potential for, perhaps a more than a slowdown than we want. That could be in the works if the Fed holds too tight for too long.
Let's talk about what's going on in the economy this week.
So the markets, the market stabilized a lot since we last spoke. So from last week, where we were just on the back of, the equity markets, S&P, NASDAQ, each down, somewhere 5-6%. We've recovered substantially all of those losses. They're up 4 to 5% since we last spoke. So very, marginally down from the points that they were before the sell-off. And, one, I think ideas of, the investors in these markets have kind of just, eased up a little bit, saying, okay, the sky is not falling. Companies still reporting pretty decent earnings. And we're seeing good economic growth, even though there's a slowdown. And we may or may not have, a higher chance of recession at this point. So I think people step back. I think, the yen carry trade, as you brought up earlier, that's, substantially unwound. It doesn't have to fully unwind. I think it's substantially unwound. And so, I think that isn't weighing in on a technical merit like it was before. And so you see, not only did the equity markets, rally, bond yields, interestingly, have continued to slightly decrease. So they've continued to assume, I think, a more aggressive rate cut environment. So the 10-year, currently at 3.85%, which, was at 3.91 the last time we spoke.
Yep.
And the 5 years at 3.68, which was at 3.73. So just marginally down, but directionally, I think it's quite interesting that these levels have stayed at a level, on the back of a very dramatic move last week. So they haven't gone back up. So it seems like there's a little bit of a consistency here, because the equity markets, they're assuming rates are cutting and they're coming back up, but they're thinking that the markets are going to be okay. There's not going to be a recession, but a slowdown, and the bond yields might be a little bit more aggressively thinking that there's a recession. We just keep watching this. Again, my feeling is that we're going to have just a continued volatile environment. Every time we get a print on some economic data that is a little above or a little below what we're expecting, you'll probably see a bit of a dramatic response, because we just don't know exactly where we're heading at this point. But I think it's pretty clear the Fed's going to have to cut. How much they're going to cut, that's the bigger question. But I think certainly by September we'll see those cuts.
Although and again, I just want to reiterate too, because one of the points I brought up in this introduction is that it is in some ways sort of this Goldilocks period for investors and assets that are dependent on SOFR, right? So for example, real estate. We're talking about real estate. We know that the Fed is going to cut rates. They told us they're going to cut rates. It's not that whether they're going to or not, it's how much. And basically, you have this situation where you can buy real estate now if you're buying with you in underwriting using today's rates, what they are right now, what SOFR is right now, the Fed rate, based on the Fed rate, where it is right now, it is buying into a descending rate environment. And so I just want to emphasize that again. I know there's opportunities that are coming through Valerity and through us that are even live right now. People really ought to be thinking about this and at least looking at those options. So let's shift gears. And I know we've got a couple of your colleagues, Ryan Haley and Jonathan Wield. Welcome back, guys.
Good
to see you.
Good to be back.
And, getting back to, our section on discussing products today, Zulfi, why don't you introduce it?
Sure. Just quickly. So Ryan works with me at Valerity Wealth. He's our in-house certified financial planner. He also has his insurance license. And Jonathan is a managing director of Unbridled Wealth. Unbridled Wealth is a really important partner with Valerity Wealth. They give us access to the best-in-class insurance products and solutions for our clients. So we work closely together for to give our clients the best possible solutions. When we last spoke, and we had the guys on about 3 weeks ago, Buck, we focused on risk management and insurance-related products. We've had, since that last conversation, several clients come to us and ask for more information. And specifically, we mentioned this kind of zero-cost premium financing solution. And so that's something we wanted to dive a bit deeper into for our audience today.
Yeah, for sure. Zero-cost premium financing. So yeah. So who wants to kick it off here? Is it Ryan? Jonathan?
Sure, I can start and then I'll hand it off to Jonathan for a case study that he's working on. But yeah, this is a pretty interesting solution that is something that we have more recently discovered and started becoming educated about, and Jonathan has shared with some clients. And it's we refer to as zero out-of-pocket premium finance. There's nothing, there's no free lunch in this world, but it's a pretty great solution for certain high net worth individuals, typically 25 million net worth or above. And the context of this is not so much focused on wealth formula banking and cash value accumulation distribution. It's more focused on estate planning and efficient transfer taxes. So as you've talked about many times, Buck, there's a pretty important thing that people need to be aware about in the end of December 31st, 2025, and the next year. Currently, unless things change, the tax code is set to have a pretty drastic reduction in the lifetime estate and gift tax exemption amount, which is currently indexed to inflation about 13.6 million per person. And so for a married couple, you're talking about over $27 million, and that is going to drop down to 5 million per person or 10 million per couple, not indexed to inflation. And that for certain people is already potentially an issue. And for others, that may well be an issue, which we'll talk about a little bit more, kind of skating to where the puck will be as opposed to where it is currently. So that's an important thing to frame in terms of context. But this is a pretty great workaround where if you are maxed out on your lifetime exemption amount or you're close to it, and that's a consideration, then this allows you to basically remove a large portion of your wealth, especially upon transfer at death, to be potentially outside of your taxable estate if it's set up correctly. And there's a lot of details to that I'll let Jonathan kind of cover in more granular detail. If you set up a life insurance policy, that death benefit is typically tax-free, but over those lifetime estate tax exemption amounts, they will potentially trigger taxable events if they're not mitigated. And so rather than paying a premium into a life insurance policy, even if it's in an irrevocable life insurance trust or ILIT, this is actually having a lender, just like premium finance you've talked about before, Buck, Velocity Plus, or things like that, where they are paying the premium on your behalf. And normally the interest that you pay out of pocket would be included, obviously much less than the premium itself in that amount. But this plan actually allows you to defer or capitalize that interest so that you're actually not paying it out of pocket, and therefore it's not being included in the taxable estate.
Okay, so all right, so let's kind of unpack that a little bit and make sure everybody understands. The first of all, you mentioned the tax the limits in terms of the death tax, right? And we've talked about that a bunch of times. I should point out that even though it's 13 million, it's going to be 13 million. It's going to go down, right? And what is it going down to?
So not indexed to inflation is going down to 5 million per person or 10 million per married couple.
And the reason I want to bring that up, Ryan, is because a lot of times in our group, for example, there may be 15 to 20% of maybe 15% of our group is going to be worried about that 26 million. But I would say probably 80%, 90% are going to be affected. But when you're talking about 5 million, 6 million, and future reductions in that amount, which are almost, especially if we see a Harris administration or something like that, it's very, very likely to go down even more. So reiterate for us. So now I have, say, for example, I have a plan basically, and I have an estate, right? And I have an estate that's already $6-7 million, right? So what is this going to do for me?
So essentially, if done correctly, this will potentially eliminate a huge portion of what would otherwise be taxable estate taxes. And by the way, I should mention that those figures we just quoted were at the federal level. Some states have even lower amounts, particularly Oregon, Massachusetts, others like that. So you got to be aware of the state level as well. But this would essentially allow you to contribute significant wealth outside of anything that will be taxable in your estate, because you are not contributing either premiums or even interest on the loan because of the way that it's capitalized and deferred back into the loan.
So it's not necessarily doing anything for that overage. It's just giving you an additional amount that would be tax deferred, correct? I mean,
right. So
yeah.
you would basically not have, you would be what would normally be if you were paying premiums or even interest on loans that were financed by a lender, those would be included in your taxable estate. This could entirely remove any of that.
So I'm sorry, say that again. What would be included? What would be included?
Well, nothing in this plan that we're talking about itself. Yeah. Obviously, if you have other things, outside of what we're talking about specifically, then those would still be included.
Yeah. Right.
So this could potentially drop, you would be able to contribute significant amounts that would not be taxable at all.
Now,
by doing
is this purely an estate play? Is there a way to turn this into potentially income in 20 years because the cash value has grown so much?
It is, and I'll let Jonathan speak more to that, the details of that. But yes, there is a potential for that. But I believe, and again, deferring to Jonathan, that this is really aimed at people where they're not as focused on the distributions from a Velocity Plus or, wealth formula banking type scenario. It's more of an estate planning thing, but it could potentially also have benefits that you just mentioned as well.
Yeah. I'm curious why. Jonathan, why? So most plans that I've heard in this genre, usually there is kind of this idea that, you obviously it's a huge estate planning play, but, you could flip the switch, 15 years down the line if there's a bunch of cash sitting there and start taking income. What's the difference?
So absolutely, that's an option. You can still turn on the spigot, if you will, and after 15, 20, 25 years, start taking that tax-free income. I would say it's not always the plan because often if people still have a lot of money and wealth inside of their estate, it can be advantageous to spend down the money inside of their estate.
Correct.
Knowing that then all of this, which is outside of their estate, is transferring tax-free, even if that the estate tax law changes and the estate tax limit comes down like it is going to in a couple of years.
Right.
So it's nice to have the option. Hey, if you need it, we ran a scenario for a gentleman recently where it was adding $25 million to his death benefit outside of his estate. Again, $0 out of pocket, but we still showed him, hey, starting at age 65, we could start taking $250,000 a year tax-free, which really, when trying to calculate your return on investment there, it's $0 out of pocket, then $250,000 tax-free for life plus money outside the estate.
Yeah.
It's pretty incredible.
That's what I'm getting at, because this is to me is the beauty of this kind of thing, right? Where you're saying, okay, well, listen, I'm doing pretty well right now, and so, maybe I won't personally need this cash. Maybe I'll be just fine. And I'm going to be able to leave a big chunk for my children. Right. And because you said 25 million and people are thinking, well, 25 million, that's a lot. Well, not if you're not paying for it. It's not a lot, right? Like $25 million worth of insurance. And then on top of that, you have this option, like you said, maybe 15, 20 years down the line, something didn't go the way it was supposed to go, and you flip a switch, and all of a sudden you have $250,000 a year in income that you didn't pay for. Yeah. So this kind of thing to me is like, I know about these things. I have these kinds of things, and I just wish people would understand the value of something like that. Yeah. What else do we need to know?
Yeah, I mean, it's funny because I've been in this business a long time and had a lot of these conversations. And honestly, it was only about a year or so ago. I'm familiar with premium finance. Our agency has done premium finance cases. But it was only about a year ago discovering this particular agency that, or this strategy that could allow you to not even pay the interest. Because I think premium finance, it's done the rounds, especially a couple of years ago when interest rates were super low. And so you saw it happening a lot more. There's even some people in trouble right now because, they were illustrating at really, really low interest rates at 2%, 3%, and now they're at 7, 8, 9%. And so the beauty about this is when we're not so worried about the interest rate today, and we're doing a very conservative long-term approach of, without getting into the technicals, we're just relying on the historical spread of the S&P 500 and interest rates, which if you go back and you look, there's always been a positive spread over long periods of time of the growth of the S&P versus prime. And that's what we're relying on for this strategy to work. So I think it's one of those things where even for people who've maybe done premium finance prior, had it not work, this is a great solution for them. And again, the factor of not using up any of your exemption or having to pay anything out of pocket is probably the best estate strategy I've seen.
Okay, so what's the catch?
Yeah. Okay. That's a great point, because otherwise everybody would do this.
Yeah.
I mean, this is absolutely for a specific clientele. So ultra high net worth individuals.
Meaning?
So we'll put it at the cap or the minimum is $25 million in net worth. Generally speaking, it's sometimes a little bit higher than that, depending on breakup of net worth. Like if you've got somebody 25 million net worth, but 23 of it is a privately held company, it's probably not going to work. But you got somebody who's 25 million net worth and mostly real estate, brokerage, and other things, and then that could work. The catch is that you have to put a collateral assignment on one of your assets. So let's say, it's $1 million premium being financed, and the initial cash value is $800,000 in the policy. We got a $200,000 gap plus the interest that's accrued. So let's say $270,000 is the gap between the cash value and the loan. So you have to put up collateral for that. So you don't have to pay anything. That's why we say zero out of pocket. But maybe you've got a property with equity in it, and we just put a collateral assignment on it. You still continue to get the rent roll, the proceeds from that investment, but there'll just be a collateral assignment. The good
so
thing
over
is,
time, though, Jonathan, I would think that the cash value would when you project it out, it would probably go up to a point where those collaterals could be removed.
Correct. And so what actually happens is the collateral need increases year over year. Again, based on illustrations, it's going to be usually 7 or 8 years. This is affected, if we're talking about somebody in their late 60s, early 70s versus somebody in their mid 40s, it's going to look different. But what you'll see is the increase in collateral need for about 7 or 8 years, and then it begins to decrease as we basically catch up and the growth is greater than the cost. And so that's where, we're looking at 10 to 15 years, depending on the person, to where you actually no longer even have a collateral need.
What if you have, say, for example, somebody has a bunch of convertible term insurance? Is this something that you could convert into?
It is if it's with one of the right carriers. So one of the things I've actually heard, I actually got accused of this being an illegal strategy recently by a financial advisor, because it is pretty uncommon that carriers will allow you to accrue the interest and not just the premiums. So not every insurance carrier allows for this. We've got a partnership with 5 mutual insurance carriers, large mutual insurance carriers, and a number of lending institutions that have approved this. And so it would just depend on who they had the term insurance coverage with. But otherwise, we've got direct relationships with these carriers and their underwriting departments to make sure people are taken care of.
Another thing that people have done in these situations, by the way, is you may have a certain amount of cash value in a different insurance policy that you already have, and you use that as collateral. So. Oh
yeah, and that's great because it has a 100% collateral usage, meaning if you had $500,000 in cash value, that counts as $500,000 of collateral versus real estate, depending on, it could be 70%.
Right.
There's a client using his watch collection, his a highly valued watch collection as collateral. Somebody's using a jet. So there's a number of different assets you can use.
Cool. Well, that sounds like great. Is there anything else we need to know about that? Is that about it?
I think that's about it, other than just encouraging if there's any listeners, viewers that are in that category or close to in that $25 million north. I think it's worth a conversation. We've been doing a lot of calls with clients as well as the tax attorneys and estate planning attorneys, and being able to just lay out the benefits of this. And so we'd be happy to have a conversation.
Yeah, absolutely.
Yeah, no, I think, again, just wanted to bring the guys out to give you another example of the types of solutions we're putting together for our clients at Valerity Wealth. So if anybody wanted to talk about that one in specific, or as we've mentioned in the past, we have free consultations with clients all the time to help them understand our services and how we can help. A big component of what we do is financial planning and investment management. And then the risk management stuff as well is quite important. So reach out to us. You can basically see it on the website. It's Valerity Wealth, VELERITY wealth.com. And if you just send me a message from the contact form there, I'll get back to you right away.
Fantastic. Thanks, guys. Always a pleasure. And, obviously these strategies are phenomenal. So we certainly have people in that category of 25 million and above. And it's, like you said, it's worth a conversation, if nothing else. Go to valeritywealth.com, and we'll see you all next week.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.